Yet another major community bank tapped out, even after Janet Yellen clearly told us the banking system remains safe and remains sound, as California's third largest bank, PacWest, agreed to be gobbled up by another regional for less than its market price. This is rare in mergers. It basically means it's a rescue. PacWest had similar issues to Silicon Valley Bank back in March, too many loans to risky tech ventures, along with falling bonds courtesy of Jerome Powell. And PacWest had been on the hospice list ever since March. They'd already lost almost a fifth of their deposits in the first 6 months of this year, including a 10% deposit drain in a single week in May, as customers worried about their money. Now, PacWest first tried to reassure depositors by unloading assets at fire sale prices. So they sold off a $2.6 billion property loan portfolio, then unloaded $3.5 billion in specialty finance loans. They sold their entire real estate lending unit, which is usually a mainstay for regional banks who dominate local real estate since the major banks have no idea how property works in Tulsa or, in this case, Los Angeles. But even that was not enough as customers kept fleeing, because while PacWest was busy patching the holes in the boat, depositors kept cashing out into money markets that pay 5% instead of the 1% or lower that banks pay. This meant PacWest was on a treadmill that goes faster than they could run, faster than they could unload assets. I've done a couple of videos on bank consolidation, how the mega banks are gobbling up the community banks. In fact, PacWest itself was a roll-up of 31 tiny banks from California, Colorado, and North Carolina, and that apparently was not enough. Accelerating into the recession, I think we're going to see more of these regional mergers as smaller banks cling together to keep from swirling down the drain. Still, I don't think it will work because small banks are in an impossible spot. They have to do two things at the same time that are in direct opposition. On the one hand, they have to rein in the risky lending so their depositors don't run away to the too big to fail banks that enjoy gold-plated bailout guarantees from Janet Yellen and Jerome Powell. But at the same time, they also have to offer depositors enough interest to keep them from withdrawing to money markets that pay 5 times more, again, courtesy of Jerome Powell's interest rate hikes. In finance, it is basically impossible to simultaneously reduce risk and raise return, meaning that they are digging the hole, they're just digging it differently. It's activity, it's not progress. So now we will see this play out in real time with this new merger. The new acquiring bank has already promised to sell off $13 billion in assets. That's over a third of the combined bank, so it starts to look almost like a liquidation. At that point, we will see whether this was an actual rescue or whether it was a drowning man pulling his rescuer down with him. Okay, we'll be watching. See you next time.